Hey everyone. All right, day 5, section number 2. So let's talk about how exactly you would price the share of a common stock. All right, and so we just finished up in the previous section talking about the 3 things that you don't know, right? When you price a share of stock, you don't know what future dividends are going to be. You don't necessarily know what your holding horizon is, how long you're going to hold the stock. And finally, you don't really know what the risk associated with the stock is. The risk is going to be in part a function of what's going on with the stock, but also it's going to be a function of what's going on for you, right? What's your portfolio? What are your objectives? How much risk are you willing to assume? So, all that said, then, how do we price a share of common stock? Well, in theory, we can use the same tools that we used in pricing a bond to think about how we price a share of common stock. So let's begin with a very simple example. Let's assume that we're going to keep the stock 1 year. All right, we're going to hold the stock 1 year. So we're going to buy it today and we're going to sell it 1 year from now. Well, then what would go into figuring out what the price I would be willing to pay should be? Well, if we use the tools that we talked about when we talked about yield to maturity, the yield to maturity on a bond is just the current price is equal to the present value of future payments. So the same principle should hold for stocks. The current price, which is price 0, should equal the present value of future payments. What are our future payments? I should get a dividend a year from now, and I also will be able to get the price when I sell this stock a year from now. So those are my future payments. But I have to discount those back, right? Discount those back, reflecting the fact that I don't get the money today, I get the money in the future. What is this discount rate? Well, here we're going to call the discount rate KE, meaning the required return on investment in equity, right? Or the required return. This required return is not just the interest rate. I mean, it is related to the interest rate, but it's also something a little bit different. It reflects the fact that for some stocks, you're going to have a higher required return than other stocks. Why? Because you think some stocks are riskier than others, right? So if this stock that you're considering here has higher risk, you're also going to have to set a higher required return, right? You're going to have to discount those future payments by the fact that you're less likely to actually get what you think you're going to get in the future. So in theory, this would be how you would, if you're going to buy a stock today and sell it a year from now, this would be how you'd figure out how you'd want to pay for it. I would just take the present value of future dividends and the present value of the future price, discounting it by my required return, which is based on how much risk I think is in the stock. So as a simple example here, if you have a required return for a particular stock of 12%, and you think the dividend is going to be 16 cents, and the price at the end of the year is going to be $60, then what would you pay for it today? You'd pay $53.71. How did I get this? Sorry, I can't do this by hand up on the board, but how I do this is I'd put in the dividend here 16 cents. Here's the price of $60, and then KE is 0.12, right? That's my required return. Do a little bit of math, and voila, I should get about 53.71. So in other words, I should be willing to pay 53.71 for this stock. What happens if the stock is selling at $50? Well, then I buy it, right? Because the stock is lower than the price that I need for it to make sense to me. What if the stock is selling at 56? Then I don't buy it because it's too pricey. Right? It's too pricey based on my required return and my estimate of what I think future dividends and future price is going to be. Now, let's take this 1 year example and extend it out. What happens if I'm going to hold it for N years? Well, then it's really the same idea, right? What should be the current price I pay today? It should be the discounted value of future dividends, right? For all n periods. So if n is 3, I need to discount all 3 of these dividends. And notice here, I have to discount them back by 1 plus KE to the power of the period that I'm in, right? So in other words, I have to discount dividends 3 years from now, back 3 years. Dividends 4 years from now, back 4 years. So I have to discount all these dividends. And then I also have to discount the price that I think that this stock will sell at when I sell it, okay? So it's really just the same as the 1 year, only now I just have to account for the fact that we have multiple years. But once again, there's 2 big problems with doing this in practice. Even if I know my required return, right? So even if I know K, I know what return I need from this stock based on its risk, there's still 2 things I don't know. First off, I don't know what the future price is going to be. However, we can say that if N is large, meaning I'm going to hold this stock for a very long time, the present value of the future price is going to be smaller and smaller the longer I hold it, right? So if I'm going to hold this stock for 40 years, I'm really discounting that future price back by 40 years. It's going to be pretty small, right? It's not going to be worth very much today. What's the biggest return I'm going to get from holding that stock is just all the dividends, right? The future price is going to be a small part of my current price. Dividends are going to be a much bigger share. The other question I don't know is I don't know what future dividends are. But I could make an assumption that if I know what the dividend today is, I could assume that those dividends are going to grow at a constant rate. We call that G. So in other words, I could make the assumption that if I know what the last dividend was, dividend next year is just going to be 1 plus G times the last dividend. Or extending this out into the future, using future value, what's going to be the dividend n periods from now is just going to be the last dividend times 1 plus G to the n power. So these 2 ways of dealing with this problem is what we call the Gordon growth model. The Gordon growth model says, listen, we have these 2 problems. We don't know what PN is, we don't know what the future price is, and we don't know what future dividends are. But let's assume that dividends just grow at a constant rate of G, all right? So all dividends are just the last period, and they just get G% bigger every period. And then let's assume that N is infinity. You're going to hold this stock forever. What then becomes the price? Well, with a little math, you don't have to solve this math, right? I will just tell you what the formula is. You can show that the current price then should just be this, right? The last dividend times 1 plus G divided by K, which is our required return, minus G, which is the expected constant growth rate of dividends. So the Gordon growth model, once again, just makes 2 assumptions: that dividends are going to grow at a constant rate G, and that you hold the stock forever. If you make those 2 assumptions, believe it or not, it simplifies down to a very simple formula for what the current price should be. The current price should just be last period's dividends, what you think the growth rate is going to be, what's your required return. If you know those 3 pieces of information, you just plug it in and you calculate, right? You just plug it in and you calculate. So the Gordon growth model is very commonly used by people in finance, not because I think people in finance believe it's correct. It's wrong, like all models, it's wrong. But that doesn't mean that it's not useful, right? It can help you think about what a price a stock should be at. It's kind of like a rule of thumb, right? It's commonly used as a rule of thumb. So it's kind of like a quick and dirty check about what the stock should be selling at. If you have some idea about what you think the growth rate is, and what your required return is, you can use this formula to give you kind of a ballpark figure of what the stock should be selling at. And so if the stock is selling at something much different than the Gordon growth model, maybe you have to raise some questions about this, right? Or you have to raise some questions about what's happening. So, once again, people in finance, they don't use the Gordon growth model. Listen, you would never buy a stock based only on using the Gordon growth model, right? It's just one piece of information, but it is commonly used because it's kind of a useful rule of thumb, right? It's a useful rule of thumb. And the Gordon growth model gets more useful to the extent that you believe the dividends will grow at a constant rate and that you're going to hold it for a long period of time, right? Because notice what happens when you make this assumption that you're going to hold it for a long period of time. You notice one of the things that drops out here is the future price of the stock. It completely drops out of this model because if you're going to hold it forever, you never have to worry about that future price. Obviously, that doesn't make much sense if you're not going to hold the stock forever, or if you're not going to hold the stock for a very long time. So the Gordon growth model becomes a lot less useful if you're not basically following a buy and hold strategy for your stock, right? So what makes a market for a stock? If everyone valued stocks the same, then there would be no market, right? It would be very simple, right? If everybody had the complete agreement about what a stock was valued, then there would be nothing interesting about stock markets. Of course, everyone values stocks differently, and so that's what makes a market. And specifically, investors really disagree about a number of things. First, they have different required returns. In other words, they have different risk returns trade-offs. Some investors are willing to accept more risk, others less. Some investors might say, well, I have a long term in which I'm saving. I'm saving for my retirement 40 years from now, so risk is not as big a deal to me. Other people might say, I'm retiring in 2 years, risk is very big to me. Or some investors might say, I have this very complicated portfolio of assets. This stock looks good in my portfolio. And other investors might say, this stock doesn't fit with my portfolio. All right. So every investor is going to have a different risk and return trade-off. That's part of what makes a market. Also, investors are going to have different expectations about how the firm will perform that will influence G, the growth rate of dividends, right? There's going to be different opinions about how well a company is going to do in the future. Some people might be bullish, some people might be bearish. Different investors have different investment horizons, right? Some investors are buying stock and holding it for the long term. Other investors might just be holding it for days. They might be thinking more about a speculative reason for buying it. The investors that have high G, meaning that think the growth rate of dividends will be higher, and that they think and that they have lower required returns, will pay more for a stock, right? So if you have a lower required return, you'll pay more for a stock. If you think that the stock is going to grow faster, dividends are going to grow faster, you'll pay more for a stock, right? That's pretty common sense. In a market, prices are always set in a market by the buyer who's willing to pay the highest price, right? So whoever is willing to pay the highest price is going to be the person who really buys that stock, right? And so market prices tend to be, or not tend, they are set by the person who values that the highest. If you do not value that stock the highest, you won't be buying it, right? And so what that means is that market prices in some sense are always set by those who expect to receive the greatest benefit from holding a stock. So if you think a stock doesn't fit into your portfolio very well, then you are not going to be the person buying it, right? Stocks are going to be bought by those who think that they're going to get the biggest benefit from holding the stock, meaning they either have the highest expectation of the future performance of the company, or that they think it fits best into their portfolio. Let's talk really briefly here about a couple of important factors that impact stock prices. First, monetary policy, right? Monetary policy definitely plays a role in stock prices. Why? Well, for a couple of reasons. First, monetary policy reduces interest rates, as we've talked about here yesterday. When the Fed increases the money supply, that pushes down interest rates. And interest rates are related to your required return. So when interest rates go down, you can also expect to see investors' required return go down, and that tends to push up stock prices. Increases in money supply might also stimulate output, and higher output means higher dividend growth. So higher dividend growth tends to push up stock prices. So in other words, stock market participants pay close attention to monetary policy. When they think that the Fed is going to be increasing the money supply and driving interest rates down, that's usually good news in stock markets. And when the Fed appears to be lowering the money supply and driving interest rates up, that tends to be bad news in stock markets. And then, of course, the other big thing that impacts stocks, and we've seen a lot of this the last month or so, is changes in risk perceptions, right? When stocks are perceived in general to be riskier, then people are going to reduce their growth projections and they're going to increase their risk return, right? And so during the 2008 financial crisis, stock prices fell by 50% as investors increased their required return and reduced their growth rate of dividends. The same thing's happening right now during this pandemic, right? Where many investors see the increased risk of holding stocks, and so they increase their required return, and then they reduce their expectation of future growth. So stocks are very forward-looking, right? When you think about buying a stock, you're really looking to the future. And so this raises a more fundamental question about how stock markets work, and that is, how do people form expectations of the future, right? How do you form some sort of forecast or belief about what's going to happen in the future? Well, there are many theories about how people form their expectations of the future. I want to talk about a couple of these today, but I'll begin with the one that, well, let's say maybe at least traditionally has been most persuasive to economists. And I'll argue that, yes, there's a lot to support this theory, but then there's also a lot to question about this theory. And that is the theory of rational expectations, right? Rational expectations, let me put up the definition here. Rational expectations is the idea that people form their expectations of the future using all available information and do not make predictable errors. Right? Let me say that again. People form their expectations of the future using all available information and do not make predictable errors. Okay. The most important thing to understand about rational expectations is it does not mean that people are always right. Okay, that is not what rational expectations means. People are not always right. It just means that people are not predictably wrong, right? In other words, they don't make the same mistakes over and over again. They make mistakes, but they're unpredictable mistakes, not predictable mistakes, right? So, an example of irrational behavior would be driving your car by looking out the back window. That's irrational. Why? Because you are making predictable mistakes. If the road curves and you go straight because you're looking out the back window and the road looks straight out the back window, well, that's a mistake that you could have avoided. That's irrational behavior. Rational behavior is looking out the front window and using what you see with your eyes to predict what's going to happen. Does that mean that there will never be any car crashes? No, but they will be unpredictable, right? There might be some hole that you can't see, or maybe someone's going to come flying out from the left or the right, okay? Those kind of unpredictable errors are going to happen, but rational expectation says you don't make predictable errors. You don't make the same mistakes over and over again. What does this then pertain, or how does this pertain to pricing stocks and bonds? Well, there's a couple of implications. If people are rational, and this is basically how economists and people in finance academics think about people, we tend to think about people as rational, meaning using all available information, then this has a couple of very clear implications. First off, what determines the stock price? Information, right? Changes in information lead to changes in behavior. In other words, stock prices should only change when there's new information. New information is what drives prices, right? Not old information. Why? Because old information should already be incorporated in a stock price. Once that information becomes available, everybody's going to change their expectation of G, or their expectation of the risk return, or their expectation of the future price, and they will adjust prices accordingly. This is what often is referred to in finance as fundamentals valuation or value investing, right? Where you essentially go out there and you use all available information to assess the value of the assets and the future profits of the firm. And then you figure out what the present value of the firm is, and you divide it by the number of shares, and that should be the price, right? That's a very rational way of thinking about what a stock should be worth. You figure out what's the value of the company, you divide by the number of shares, that's what you pay the stock price for. So rational expectations suggest that only when there's new information about the value of the company should there be a change in price. Prices should not change unless there's new information available. Second, rational expectations says that yes, there will be mistakes, but they won't be predictable mistakes, right? So in other words, on average, there's going to be no error, but not every period, right? There will be positive errors. Sometimes you'll set stock prices too high. Other times you'll set them too low, but in the end, they will all average out. And then third, and this is the one that we're going to talk about the most here in the next section of our lecture, and it's the one that people probably have the hardest time wrapping their minds around. But if everyone is rational, then it's impossible for any individual to be smarter than the market. In other words, you can't beat the market. The market is smarter than you. Why? Because the market has all information, right? Stock prices reflect all available information. There's no way that you as an individual are going to have more information than the stock market. And so you will not be able to beat the market because you're not smarter than the market. There's only two ways that an individual could beat the market, right? One, well, let me say this. There is a way that an individual could beat the market. That's just pure dumb luck, right? You could be lucky, and that happens, right? Some people are going to randomly beat the market. Other people are not going to randomly do worse than the market. But, you know, there's not much to be said for luck. There's only, outside of that, there's really only two predictable ways. One is that you've processed existing information more accurately than markets, which is highly unlikely given the vast number of people that scan the newspapers and every day looking for opportunities to make a profit, right? The fact that you are somehow looking at public information and incorporating it more quickly than the market is very, very unlikely. Or the second is that you have information that the market doesn't have, which is not only unlikely, but if you do have better information, it could be illegal, because this is what insider trading is, right? Basically, insider trading is trading on inside information that is not publicly available. So if you have information that is not publicly available and you trade on it, that is potentially a felony. So assuming that you don't have inside information, there's very, very little chance that you are smarter than the market, right? And so what does this mean is that you can't consistently beat the market, right? And that is a hard concept for people to accept. And so I want to come back and talk about this in some more detail here in the next section, right? Why is it that most economists believe that you cannot consistently beat the market? And then what are the implications for being engaged in the market? All right, so we'll come back here in a minute and talk about the efficient market hypothesis and what your strategy should be when it comes to saving in the stock market. Back in a moment.